Today's video is a request from Don James and he asks, page 60 of the Stock Traders Almanac describes the best 8 months applied to the NASDAQ. Could you change your coding to look at QQQ for the best 8 months? The quote that he was referring to is from my previous video, Sell in May and Go Away, where I showed that not only is it not profitable to sell in May and buy back in November, it really doesn't make a lot of sense. But in his question, Don specifically refers to the Stock Traders Almanac and something known as the best 8 months of the NASDAQ. I did a little digging and this is what I found. We see this article here that says June outlook, the best 8 months and midterm machinations suggest cruel summer for stocks. And if you scroll down the Stock Traders Almanac, we would see that the end of NASDAQ's 8 best months has been described over here. Highlighted in yellow, we see that as we enter the cruel month of June, the last month of NASDAQ's best 8 months. So with this sentence, we can tell which are the best 8 months that they are referring to over here. The 8th month being June, we count backwards. The first month would then be November. So the months from November to June is what the Stock Traders Almanac says is the best 8 months of the NASDAQ. The Stock Traders Almanac then provides a lot of geopolitical news analysis as well as technical analysis to support their point that these are the best 8 months of the NASDAQ. Personally, myself, I prefer to look at the dry data. Not that I'm saying that the geopolitical news is not important. It is. But just looking at the dry data itself, what can we see from that? What kind of patterns can we deduce? And from there, let's make some sort of analysis. Is the best 8 months of NASDAQ actually credible? So as usual, I'm going to do my data analysis in R language. If you're interested in getting the code, you can click on the GitHub link below to access all of it. Do support my channel by clicking on the like and subscribe button. I also have a Patreon page where you can suggest what research topics I should do for my future videos as well. Without further ado, let's dive deep into the analysis. Unlike previous studies of the SPY where I took only 20 years of data, this time I'm going to go right back to the genesis of the NASDAQ, 1971, all the way up to 2019, so we will have 49 years of data to play with. With so much data, I would then be able to slice my data by the decades, so I can then take a look at what the 1970s were like, how the NASDAQ performed in the 1980s, the 1990s, and so on. I think that will make for a more interesting analysis. One peculiar thing you would have noticed is that the ticker symbol of the NASDAQ is not QQQ. QQQ is the ETF of the NASDAQ, but the NASDAQ index itself has the ticker symbol of IXIC. IXIC has data going all the way back to 1971, which is what we want to use for this particular study. As usual, Yahoo gives us the prices on a daily basis. In this video, I'm only interested in the closing prices of the IXIC. From this, I wrangled the data to provide me with the closing prices of the months and the years. I went a little bit further to get the percentage changes as well as to create a new column called decades. There's also an additional column called decade_code, which allows me to use for loops to make the data analysis go faster. Right, so now let's dive into the study. I'm going to break my study down into 3 parts. So now, let's go to part 1, the changes from November to June. In order to determine whether the NASDAQ rise or falls from November onwards, we need to set a new benchmark price at the closing price of October. From that point onwards, we will be able to take the closing prices of the months ahead, do a calculation and see what is that percentage change based off the closing price of November of that year. We then repeat this for every single year up to 2019. Using this method, we will truly be able to see whether there is an increase in the NASDAQ from November to June every single year. The first result of this study is a heat map. At first glance, this heat map doesn't seem very conclusive. We see a couple of red spots here and there, and those red spots correspond to those years where the NASDAQ did very, very poorly. Case in point was the year 2001, where it was the dot-com bubble and the NASDAQ was very badly affected. Generally, everything else was a blend of red and green. We cannot really tell there's a majority of greens, and therefore we also cannot jump to the conclusion that it is definitely more bullish. But what if we slice the data into the decades though? Let's take a look. Interestingly enough, when we slice the data, we see that there are certain decades that are more green than others. Some decades had better performances in the months of November to June than others. Take for instance the 1990s. 1990s showed more bullishness than the other years, as we can see from the heat map. But then this leads to the question, how do we know which decade is going to be more bullish than other decades? This is of course the million-dollar question. Perhaps this is why the Stock Traders Almanac supports their hypothesis by using geopolitical news and technical analysis. The box plot then shows the spread of the gains of every single month from November onwards up to June. we see that the median of the gains are generally above 0. So the months from November up to June typically tend to increase and become bullish. There are of course a couple of outliers deep down in the negative region, as you can see in the dots below. So far though, this data is not enough to convince us to say that these 8 months are anything special compared to any other months. They seem like they are climbing, but they don't seem like they're climbing in any stellar fashion. When we throw off 49 years of the best 8 months into line plots, we see that the majority of the lines are again above 0. So they are typically bullish. There are a couple of years where the line plot really dips very low, as you can see in 2001. Even though majority of the lines are above 0, again we cannot come to that conclusion that this means that these 8 months outperform, because there is no other basis of comparison. This part 1 over here is just to take a look at whether these 8 months were bullish or bearish, and that's it. Now to be able to tell whether these 8 months perform any better, we would then need to take these 8 months and look at them in context with the rest of the months of the year. So that's what we're going to do in part 2. So part 2, we're going to be looking at November to June with respect to the entire year. And let's see what we get. When we look at the box plot of the percentage changes throughout the entire year, we see that there isn't anything very different about any of the months. I have grayed out that window from July to October, and this window from July to October are the months that we should be excluding from our study. Every other month that is not grayed out are the months from November to June. We were expecting to see that the grayed out region would dip lower than the other remaining months, meaning to say that we wanted to see July to October performing poorly, hence the other months will do better. But this does not seem to be the case. At least visually, it doesn't seem that way. But just as we think this strategy is not going to work, when we look at the mean of the percentage changes month on month, we see something very different. From the months of July up to October, we see that these 4 months are the worst performing months on average compared to every other month. In fact, the months from August to October dips into the negative region. If you compare this to the median graph on the right, we see that all the columns are green, which means to say, once again, that outliers here are having an oversized effect on the mean. There are certain years where the performance was so poor, it drags down the mean and skews them negatively. So, what do we make of this? Well, I'd say there might be something here, because the months of July to October seem to perform very poorly in the mean, even though the median kind of evens them out. But even the median, you see that there are a couple of months where there are actually some of the worst performing months of the entire year. Perhaps this is a clue that there might be something here that we can work with. Might be a little bit of credibility. What about count then? Let's count the number of years for a particular month where that year was up versus that year being down. You can see over here, these are the proportions of years that were up versus years that were down. Green indicates the proportion that was bullish, red indicates the proportion that was bearish. Although all the months here seem to show a larger proportion of bullish than bearish years, those 4 months again from July to October that we should be excluding are the 4 lowest proportions. Is this a coincidence? I don't know, but it does seem like there is a higher proportional chance of these 4 months being bearish. But ultimately, the statistical proof we need is to do a t-test. We need to be able to determine with some statistical certainty that these 8 months from November to June are performing statistically better than those 4 months from July to October. With a one-sided t-test, we want to see that the p-values are smaller than 0.05, and if that is the case, we can then say that yes, these best 8 months of NASDAQ are indeed the best 8 months, they perform better than the other 4. But unfortunately, the t-test doesn't seem to show this result at all. In fact, it's not even close. The p-value is very large, meaning to say that we cannot conclude that NASDAQ's best 8 months outperform the other 4 months. Now, this was done with all 49 years taken together. What if we slice the data by decades? Would that be any different? Let's take a look. Unfortunately, by slicing the data into decades, the t-test still doesn't show any good results, or at least not the results that we prefer to see. The t-test shows that even by decades, the best 8 months of the NASDAQ do not outperform the other 4 months of the year. This is despite there being certain decades whereby the NASDAQ performed very well. Is all hope lost for this particular strategy? Statistically speaking, there doesn't seem to be much hope left anymore. So let's think about what would happen if you invested in the NASDAQ using this particular strategy, buying in November and selling in June for 49 years. What would we get? Compare that to a simple buy and hold strategy. Would you expect anything different? So hence, this is part 3 where we do the portfolio results. We want to take a look whether there's any difference in these two portfolios executing the 8 best month strategy versus a simple buy and hold strategy. In this final part of the study, what I'm going to do is I'm going to buy the NASDAQ from the months of November to June, and then I'm going to sell from July to October. Cumulatively, what kind of results do we get? What are we actually expecting over here? Now, the results of this part of the study really surprised me because out of 5 decades of our study, 3 of those decades showed that the best 8 months in NASDAQ strategy outperformed the buy and hold strategy. 1970s, the 1980s, and the 2000s as well. Let me explain. In the 1970s and the 1980s, the best 8 months of the NASDAQ strategy just simply did better than the buy and hold strategy, as you can see from the charts. In the 1990s, however, this is not quite the case. The NASDAQ probably did very well in those 10 years because that was the years where the .com really started to bubble and get bigger and bigger. You would expect in those years, this best 8 month strategy would outperform, but that doesn't seem to be the case. Because if the entire NASDAQ was growing every single month, regardless of what happens, then missing out on 4 months of the NASDAQ would reduce your portfolio gains quite significantly. And I guess that was what actually happened. Then came the 2000s, and lots of bad things happened. The .com bubble burst, the NASDAQ tumbled, and then we also remember that in 2008, the Great Financial Crisis happened. This is where it was quite interesting, because if you did a buy and hold strategy, you would have lost more money than if you executed this best 8 months of the NASDAQ strategy. In fact, by using the best 8 months of the NASDAQ, you would have saved yourself about half the losses compared to the losses you would have if you did the buy and hold strategy. Finally, in the 2010s, the best 8 month strategy again couldn't compete with the entire year's worth of gains. So out of these 5 decades, we can see that the 1970s, 1980s, and the 2000s, this best 8 month strategy was actually better than the buy and hold. Now, taking everything into consideration, what if we did a buy and hold strategy compared to just carrying out this best 8 month strategy for 49 years? We would expect that since the best 8 months of the NASDAQ already outperformed 3 of those 5 decades, it would probably do better than buy and hold, wouldn't it? But surprisingly, that is again not the case. If we did the best 8 months of NASDAQ strategy over all 49 years, it performed poorer than a simple buy and hold strategy over 49 years. But why is that the case? I suspect the reason is because by the time the 2010s came around, the value of the NASDAQ is 80 times what it was in the 1970s. To put it in a different way, a 1% difference in the 2010s is 80 points. That same 1% difference in the 1970s is only 1 point. So despite the best 8 month strategy working better in the 1970s and 80s, when the 2010s came around, there was an exponentially big difference in the NASDAQ by then. And whatever buy and hold gains that we had in 2010s overshadowed those that happened in the 1970s and 1980s. Hence, taking everything into perspective, the last 10 decades really washed out all the benefits of the best 8 months strategy in the earlier few decades. That's of course not to say that the best 8 month strategy is not a good strategy. In fact, I think there is something quite interesting here that we are seeing. Now for one last experiment. I'm still kind of skeptical that this best 8 month strategy would actually work. Why are the 8 months from November to June? Why can't the 8 months be from some other month? For example, why not from January to September? Or March to November? Why not? Let's test that hypothesis a little bit. Rather than excluding July to October, I'm going to exclude other months. I'm going to start by excluding January to April. And then I'm going to exclude February to May, and so on. Every one of those times, I'm going to calculate the gain over those 49 years. And let's see which window will give us the best results. And again, surprisingly, this was not what I expected. It turns out that if we exclude the window from July to October, those same 4 months that was recommended by the Stock Traders Almanac, this is where the strategy performs the best. If we excluded other months, say for example March to July, cumulatively over 49 years, this strategy would not perform as well as if we excluded July to October. So what the Stock Traders Almanac is saying seems to be correct. If we exclude July to October and only buy the NASDAQ from November to June, we would get the best results compared to if you stayed away in any other 4-month window. So what's our conclusion here? Well, statistically we have shown with the t-test that these best 8 months do not outperform the other 4 months that we have excluded. So statistically speaking, this strategy doesn't work, or at least it doesn't seem to show that there is any outperformance in any way. However, portfolio-wise, we do see something quite interesting. We have seen that 3 out of 5 decades, this best 8 month strategy actually works. Well, at least they seem to outperform the market at those particular decades. Overall though, it still did not outperform a simple buy and hold strategy for all 49 years, but that is simply because in the past 10 years the value of the NASDAQ has ballooned. But why is it that those 8 months seem to do better than the other 8-month window? Why is it that it does better in November to June rather than from March to November? To me, this is an enigma. In fact, it is bordering on statistical luck. I probably wouldn't execute this strategy myself, but I can clearly see some people would be very interested in this particular strategy, and you might be too. Would you use this strategy? Let me know in the comments below. And that's all for this video. If you enjoyed this video, please click the like and subscribe button. I have a Patreon page if you'd like to suggest some research topics for me to do for future videos. That's it for this week, and until my next video, see you next time.